Go ahead and begin our recording. Welcome everyone to our LiveView Virtual Learning Academy. On behalf of the Wood County Committee on Aging, I welcome Chad Plontz here today to discuss his topic of mutual funds.
All right, very good. Danielle, thank you very much for the introduction. Once again, my name is Chad Plontz with Edward Jones here in Bowling Green. We're located on West Wooster at 519 West Wooster near downtown. So once again, I appreciate everybody joining us here today. I'm going to go ahead and share my screen then. So hopefully everybody's seeing that, and hopefully we won't have any technical difficulties as we move forward here. But as Danielle had mentioned there briefly, the topic for today is an investor's tour of mutual funds. So we'll be discussing mutual funds a little bit today. And giving you some pointers on what are mutual funds, what do they do, and what should you be considering or looking for when you're discussing mutual funds. So at the end here, we will have some time to answer any direct questions, of course, like Danielle said. But once again, I appreciate everybody for joining here today. So we'll go ahead and get kicked off. So today our seminar is designed specifically to help you become a more educated investor and to assist you in working toward reaching your unique goals. Goal setting is obviously very important. It helps you better define your overall strategy and understand whether a specific investment can help help you in pursuing your goals. So your goals and the goals of the person that you may be sitting with may not be the same. Everybody has their unique goals. So this is where here at Edward Jones, we have a specific 5-step process that we follow. And it's clear, in step one, to have a clear outlook on your future. Your first step is to evaluate where you are today. And only then can you really begin to set clear and measurable goals for where you'd like to be in the future. So once you've decided on your goals, you should evaluate whether or not they're realistic. So this determination is based on the amount of time you have to invest and the investments you're comfortable with. These are also known as your time horizon and investment suitability. This look at risk tolerance and life stage is crucial in forming a framework for your portfolio. So at Edward Jones, we have we use an investment pyramid to illustrate the desired allocations between different types of investments and then the allocation going forward. So a trusted financial advisor is somebody that can help you decide the solutions and strategies that are going to help work best to help you reach your goals. So hopefully you're working with somebody now. If not, I would obviously welcome an opportunity to speak with you further. So now once you've set your strategy, you need to make sure you're able to stay on track and periodically evaluating where you are, whether you've reached your goals or there's new goals that you would like to achieve. Is your current situation and strategy for that situation, is your strategy actually working for you, or are there adjustments that need to be made? So today I'll give you a tour of mutual funds, which is one of those many tools that can help you reach your goals as part of a comprehensive investment strategy. Excuse me. So today's program, we're going to cover a couple different things here when it comes to mutual funds. So what you're seeing here is the first thing is the basic features of mutual funds. We'll discuss that briefly. We'll also discuss the benefits and trade-offs specific to mutual funds and qualities to consider when selecting a specific mutual fund. All right, so let's, I guess, first of all, touch on what we won't discuss today. So what we won't be talking about is the hot tips, right, for picking the best funds. And why is that? Well, there's no one mutual fund that is best for everyone. That's why it's important to understand how mutual funds work and how they are put together and the purpose of mutual funds you are considering and the perspective on how it's going to fit into your specific strategy as well as a diversified portfolio. All right, so I think a good place to start here is maybe a brief history lesson on mutual funds. Before, where did the first mutual fund really start, right? So the idea of pooling money together for investing purposes actually started in Europe in the mid-1800s. Well, in the United States, the first pooled fund was created in 1893, and that was for the faculty and staff of Harvard. So it wasn't until March 21st of 1924 that the first official mutual fund was born, and it was called the Massachusetts Investors Trust. So, at that time, after 1 year, the Massachusetts Investors Trust grew from $50,000 in assets to $392,000 in assets, with around 200 shareholders. So, 200 shareholders, man, you can see how obviously this has grown over the years, to put it lightly. So, once again, just a short history lesson there on where mutual funds or pooled funds really originated. So then, we come to this slide here, and it's what is a mutual fund, right? So let's answer that. And some of you may be familiar with what a mutual fund is. This type of investment may be part of your 401k or a past 401k, or even your IRA, right? So here's the technical definition. A mutual fund is actually a professionally managed investment, and it pools money from many investors, right? You invest your money, somebody's going to take that money, and they're going to take that pool of money, yours plus everybody else's, to go out and invest in stocks, bonds, short-term money market instruments, and other securities. So we can obviously simplify that definition a little bit. The mutual fund is like a bag of specifically chosen investments. So when you invest in a mutual fund, you buy shares of the fund itself, or of that bag, right? Your money is then pooled with that of other fund investors. And then a professional money manager or money management team then invests that pool of money into a variety of securities, such as stocks and bonds. Now, there may be many varieties of mutual funds, right? Each mutual fund has a stated investment objective. So you can think of objectives as statements that start like, this fund was created to blank, or this fund will be made up of stocks that focus on blank. So the investments within the fund are actually selected by the fund's money managers to help meet with the investment objective. Another way I like to kind of explain this is, think of a chili cook-off, right? There's chili cook-off. There's all kinds of different chilies. There's the 5-alarm chilies that are super spicy, and their objective is to be a spicy chili, right? There's the sweet chilies. There's all kinds of different chilies, and they all have different objectives, right? What do they want to be? What's the purpose of this chili that they're putting out? And then on top of that, well, yeah, there's spicy chili, but now you have fund managers or money managers or chili managers that think they have the best way of making chili, right? Well, now that we have the objective, now we have all these different options of who makes it the best, right? So you can think of it that way in terms of mutual funds, much like a chili cook-off, right? There's many different objectives, but who's doing the best of the best, right? So let's talk about the different ways that mutual funds can make money, right? So there's a couple different things here, and this is what you're seeing on the slide. There's actually 3 ways here. The dividends and interest, it can increase in share price, and then there's also capital gain distributions. So we'll take a closer look at each of these and how the taxation is handled on them as well. So we'll start here with the interest and dividends, right? So if there are bonds in your mutual funds, so once again, mutual funds can be made up of many different types of investments. It doesn't only have to be stock, it doesn't only have to be bonds. So if you're purchasing a mutual fund and there's bonds inside the mutual fund, they could earn interest, much like an individual bond can. And if there are stocks within the fund, they could pay dividends, much like individual stocks can pay dividends. So the mutual fund will be subject to expenses and pass these earnings on to you as dividends throughout the year. So you can elect to either receive those dividends in cash, creating yourself a paycheck in retirement, right? That's one way many people can do that. Or you can reinvest it, you reinvest those dividends into more shares of the fund. So if you're still working and you're just trying to accumulate wealth, you can always reinvest those dividends because you don't need the money at that moment to purchase more shares of the fund. So whether you receive cash or reinvest the dividends, these dividends are taxed in the year they are distributed. So the second way to earn is for the share price of the mutual fund to increase in value, right? The increase or decrease in value. So an increase in value, though this is one way that mutual funds can earn money, it's possible that the fund can decrease in value as well. So before we continue on how mutual fund gains are taxed, we're going to actually talk about mutual funds and how they're priced. So that's where you're seeing net asset value. So the value of your shares is actually determined at the end of each business day. So they're not like stocks that trade, you can trade at whatever it's trading at during the day. So the actual value is determined at the end of the market for the day. So this is called the net asset value, or the NAV, as you're seeing on your screen. The NAV of each share of the fund is calculated actually by finding the total value of all the securities in its portfolio and then subtracting any liabilities and then dividing that number by the number of fund shares outstanding. So once again, a little complex there, but if the price of your mutual fund shares increase over time that you own them, you'll make a profit. And when you sell them, it is also possible that that price could obviously that price could decrease as well. But the price appreciation of your mutual fund shares is not subject to tax until you sell the shares. So once again, you wouldn't be subject to tax until the shares are sold, not simply by them increasing in value or decreasing in value. So, excuse me, when a mutual fund's management team sells a security, though, within the fund, so if there's a mutual fund that you own and it has stocks in it, right, and they sell one of those stocks, well, the management tells the team is selling that security within the fund at a profit, well, then there's a capital gain that is realized. So capital gains are periodically paid to fund shareholders in capital gain distributions. Typically, you see these towards the end of the year in December. And then once again, you'll be at tax time when you give your tax documents to your tax professional. They will be discussing capital gains with you and the tax consequence to those. So as with a dividend, you can elect to receive the capital gain in one of two ways. Again, you can have it in cash, or you can reinvest those capital gains into additional shares of the fund. So whether you receive cash or reinvest the capital gains, these gains are taxed in the year they are distributed, right? So if it was in December, well, it's December of 2020, well, 2020 is when you're going to be paying those taxes. You don't have to own the fund the entire year to be subject to the entire capital gain distribution. So you do want to be careful on when you're purchasing and selling mutual funds, because you may only own a mutual fund for a month or two and end up having to pay the full capital gain distribution for the full year. So once again, something to continue to have conversation about with your advisor. So if you own a mutual fund, it's important to find out when and how the fund managers handle capital gains and capital gain distributions, so that you're prepared come tax time and you're aware of your tax consequences. If you do own mutual funds inside of a tax deferred or a retirement account, right, something like a 401k or your traditional IRA, you will not pay taxes on the earnings or the growth. So those capital gains and dividends, you don't pay taxes on any of that until it's withdrawn. You're not paying taxes on a 401, everything you take out of your 401k and traditional IRA has a tax consequence. So you're not seeing that until you actually take it out of the account. So the longer you can delay paying taxes, the better the potential to accumulate retirement savings. So if you own mutual funds inside of a Roth IRA or a Roth 401k, well, that's, all of those earnings and growth, it's tax-free, right? A Roth is set up for tax-free growth. So. All right, so the next portion here, everybody is fee conscious, right? So the fees are an important consideration with mutual funds as well. Each mutual fund has several kinds of fees, all of which are paid from its returns, not by the shareholder. So what does that mean, right? If the fees are paid from its returns and not by the shareholder, what that means is when you when you're looking at the value of your mutual funds, there's internal fees that are taken out of the value of the mutual fund, which will never necessarily show up on a statement, right? Because you're the shareholder, you, the investor, is not the one paying the fee. It's kind of tricky in regards to that, so it's not overly transparent. That's why you're going to want to do some research. So these additional fees vary among mutual fund companies, so it's important to read the fund's prospectus thoroughly before investing. And a mutual fund's prospectus is the fund's basically the sales document that contains valuable information about the investment objectives and goals, the managers and advisors that are on the mutual fund, and then of course the fees and expenses, and how much or how to purchase or redeem fund shares. So, in addition to the ongoing fees of a mutual fund, is the cost of the mutual fund shares. There are certain mutual funds, offer different what they call share classes, where you may be in a scenario where you're paying upfront percentages to purchase a mutual fund. Some do not, but then there's ongoing annual fees that come out of the mutual funds as well. So once again, there's they are complex when it comes to that. I would strongly urge you to have that conversation with your financial advisor about the fees, internal expenses and fees that are come with mutual funds. So. Now, at Edward Jones, we believe mutual funds are long-term investments. So the longer you hold your funds, the more likely you are to smooth out the price volatility that can occur over the short term. Investing in quality mutual funds that are well managed, holding your fund for a meaningful period of time and rebalancing your portfolio periodically may help you reach your long-term investment goals. So, all right. So map to mutual fund selection. So, as I mentioned earlier, we have our 5-step process that we use to help clients establish their goals and formulate a strategy. Obviously, those things are very important to understand. And what I like to say is, you wouldn't just go out and simply buy a good car, right? You'd want to think of what a good car is for yourself and your needs, right? So really, making this more customized and personalized for your specific strategy. So it's you don't want to just go out and buy a good car. So it's very much like that with mutual funds, right? Mutual funds offered should be based on investor objectives, right? Because there's many different types, right? Many different types of Chile, many different types of mutual funds. There are growth funds, there are income funds, there's balanced or growth and income funds, there's international funds and sector funds. So in general, you want a mutual fund that is suitable for your objectives. So we'll address this more in just a moment when we talk about fund objectives. Additionally, you must understand how much risk you are willing to take. With mutual funds, as with any form of investing, you need to understand your risk tolerance. The question to ask is, how would I feel if the value of my investments went down, right? Well, this is what I like to call this, the gut check or the stomach test, right? Because the markets will go down just as they will go up. We just don't know when, right? We can't control the market. So I use the risk tolerance questionnaire with my clients to better help understand how they view risk. So, you may ask, well, why not just avoid risk altogether, right? Well, you may have heard of the phrase, well, there's risk versus reward, right? You'll need to take on some risk to stay ahead of inflation, but understand risks you're taking and be prepared for some ups and downs over the long run. So investing in mutual funds is one good way to buffer the volatilities of the equity market. So of the stock markets, the volatilities that can occur. It is much like having a diversified portfolio in the sense that when you have a diversified portfolio of investments, you can generally rely on one type to do well when the other type is doing poorly, right? So they kind of balance each other out. The diversification of a mutual fund, you can go buy one mutual fund, and that mutual fund, once again, information that's shown on the prospectus, will tell you what the holdings are. So a mutual fund that is in equities, the stock market, may hold 100 or more or less individual stocks inside of it, right? So if you had money available, if you wanted to diversify the money that you had, Do you have enough money to properly diversify and go out on your own and buy individual stocks? Or would you rather have professionals managing that money that you have to invest to go out and diversify the money with the stocks that they have inside of the mutual fund? So that's really how this works. So back to the prospectus. First, if you do have mutual funds or you're looking to invest in mutual funds, get a prospectus from your financial advisor or the mutual fund company. It's a document, once again, that's updated, at least once a year. Contains very valuable information about not only what holdings are inside of the mutual fund, but what are they trying to accomplish. Once again, the managers, the fees, the expenses as well. So with your investment goals in mind, read the prospectus sections on fund objectives, goals, risks, strategies. You're going to want to look at all those things. So for example, let's say you are retired, and when you read the prospectus, you found out that a fund has an objective of high growth and a strategy to buy initial public offerings. So when stocks hit their IPO, right? It's their first public offering, initial public offering. Well, if you're retired, do you think this fund is appropriate for your investment objective? Well, most likely it won't meet your objective, because individuals heading into retirement or that are in retirement are beginning to focus on more on generating reliable income and taking less risk with their investments. So, another thing to consider is who manages the fund and works on the fund management team. You'll be able to find out about their experience and track records. After the fund's narrative description, there is a performance bar chart that'll show the fund's total return for each of the past 10 years, as long as the fund has been around or in existence for that long. So, long track record, successful track record with successful managers that have been around a while are definitely good things to look at. Volatility, right? It's important to look at volatility. Big increases or big decreases in returns over a period of years. Well, generally, the more volatile this fund is, the more risk tolerance you will need, right? You're not somebody that you can't be somebody that doesn't like, a lot of fluctuation in their account and, can't stomach, seeing a loss on a statement, and then go out and look at an investment that has high degrees of volatility. So most prospectuses also have a table that shows after-tax returns. So this is necessary because, as I mentioned before, depending on where this mutual fund is sitting, whether or not it's in your 401k, which then you won't necessarily have to worry about the taxable consequence. But if it's outside of a 401k and in a taxable account, the sales of securities are taxable events, and you're going to want to make sure those are tracked. So there are also financial highlights that give you insight into how the investment company performs as a business. So how well does it manage expenses, and what is its sales trends, things like that too. So the last thing on this page here is the fees and expenses. There should also be a table on the prospectus that describes the fund's fees and expenses. It'll break it down into a percentage, an annual percentage for you. So as we discussed earlier, this is an important consideration, obviously, as you weigh your decision on mutual funds, because different mutual funds have different fees and expenses. They're not all equal. Some can be quite high, and some can be on the other end of the spectrum as well. So, all right. So mutual funds roles in your portfolio. So now that we've broken down the features common to mutual funds and how to evaluate funds on their merits, well, let's address the most important question of all, and that is, well, are mutual funds right for you, right? Do they fit into your investment strategy? And the answer to the question depends, once again, on your goals and your risk tolerance. Let's view this from the perspective of benefits and trade-offs associated with mutual funds. So there are 5 key benefits to owning mutual funds. 1 is diversification. 2 is professional management. 3 is liquidity. And then we have discipline and choice. And as with all investments, there are risks involved with mutual funds, and we'll discuss those risks as we go through the benefits as well. But feel free to take notes on some of this here. How this works is many investors are going to choose to diversify, right? So to diversify across a variety of mutual funds to take advantage of having different money managers and investment selections within your portfolio. Not just owning one mutual fund, just like not owning just one stock, right? Mutual funds face many of the same risk as individual investors. So for example, a mutual fund may have to redeem a bond, right? So if you own a mutual fund that has bonds in it, well, the mutual fund may have to redeem a bond at par value if the bond is called by the issuer. So if you own individual bonds, there's potential for a call date, which means that the bond can actually take back that bond. They'll pay you the principal that you put in, but then they don't have to continue to pay out the stated rate of interest. So this is called a call or prepayment risk. If the bond's par value price at redemption is less than what the bond was purchased at, well, the mutual fund may experience a loss, right? And mutual funds works a little different than just what an individual bond does. So another risk I mentioned earlier is that your shares may decrease in value and you may lose money. Well, this is no different than the risks faced by individual investors, and it is referred to as performance risk, right? The idea that you're going to buy a stock or a mutual fund and that 6 months from now it may be lower in value than it was when you bought it. So also fixed income and equity investments tend to act differently. And what we're referring to here is fluctuation risk, right? Their risks and performance are often used to offset each other's gains or losses. But again, past performance doesn't guarantee future results. So it's important to understand that diversification in and of itself doesn't guarantee a profit or protect you against loss. In the same way that stocks owned by a mutual fund may fluctuate in value due to market conditions, causing the value of the fund to fluctuate as well. So we call this fluctuation risk because the risks of like these, a mutual fund company cannot guarantee, results. So another benefit, sorry, I'll change the slide here for you. Another benefit is that each fund is run by one or more professional managers. So we mentioned that the managers earlier, so money managers can change, right? But so there's no guarantee there, but we kind of jumped into a little bit about what managers do with the chili analogies there. So ultimately, the money manager is doing what an individual investor would do, right? An individual investor, is going to go out and look for investments that they want to go buy, right? What individual stocks do I want to go buy? Money managers are doing the same thing. So the question then becomes, are you somebody that likes to do the research and has the time and the knowledge to be able to pick investments, that are good performers? Obviously, there's no guarantees for anybody, you, the individual investor, or a mutual fund manager, but what knowledge do you have or desire to do that on your own? Mutual funds can obviously provide that value in terms of the professional management. So, all right. So the next part there is that liquidity, right? Mutual funds are also considered liquid investments. And what do I mean by liquid? Well, the mutual funds are considered liquid because they can generally be bought or sold for cash on any typical business day. So you may receive obviously more or less than your original investment, but if you needed the money, you could sell the mutual fund any day. Because of the liquidity of mutual funds, you can often easily exchange them from one fund to another within the same mutual fund company or family is what they call them. You should know that if you switch from one fund to another within the same mutual fund family, though, you may still be subject to taxes unless it is held in a qualified account like a IRA or a 401k. Your tax professional will be able to assist with questions in regards to that. So. But however, because of the fees involved with mutual fund transactions, we don't typically recommend using them as short-term trading vehicles, right? Some of these mutual funds have upfront costs. So you could be looking at a large upfront cost, and if you're only in it for a short period of time, it's going to be hard to make up that upfront cost. So mutual funds can be an appropriate investment for large or smaller sums. Once again, due to the diversification. Investment minimums will vary based on mutual fund companies. So you'll just need to take a look and research the mutual funds that you're interested in. All right. All right, so when we say disciplined, right, mutual funds are another way that you can help train and enhance your skills as a disciplined investor. You have the opportunity to systematically actually invest into mutual funds. So systematic investing is when you invest the same amount of money or on a regular basis. So for example, $1,000 each month, right? Well, this way you buy fewer shares when the prices are higher and more shares when the prices are lower. It's what we call dollar cost averaging. So you're taking advantage of the market at the highs, the mids, and the lows of the market. You're constantly systematically investing. So another feature of mutual funds that helps add a disciplined approach is you can reinvest your earnings again, right? So if your mutual fund pays a dividend or capital gain distributions, you can choose to automatically just reinvest that money into more mutual fund shares. So once again, is that part of your strategy for additional growth as a disciplined investor, or are you in a stage where you're looking for income, right? So this can allow you to grow the number of shares you own without an out-of-pocket expense. So the final benefit of mutual funds is that of choice, right? An investor can go and find a mutual fund to fit most investment goals. Many fund families now offer international funds, equity funds, balanced funds, bond funds, sector funds. I mean, there's a fund for everything that you're looking for. So and most mutual fund companies that you're going to be looking at are going to offer a variety of all of those. So back to the risks, right? We've mentioned a couple so far, but here are a couple of risks I'd like to reiterate. First, if the value of the investments held within the fund fluctuates, so will the value of your mutual fund, right? So once again, if you see fluctuation in the stocks that are owned inside of that mutual fund, well, it's a pretty good chance if you see that Apple is up or down for the day and that stock is inside of your mutual fund, there's a potential that your fund's going to be up or down for the day. It just depends on all of the different holdings inside of the mutual fund. So, once again, you have the ability to, increase or decrease in value. So one other risk that I'd like to point out has to do with mutual funds with international holdings. While these types of funds can provide a way to diversify internationally, it's important to understand the risk involved. In the case of international investing, there are some special inherent risks, including currency fluctuations and foreign political and economic events. So once again, could be a good portion of, or a good part of your portfolio and strategy, but once again, something you'll want to discuss with your advisor. So we've covered a lot of ground on mutual funds here in a short amount of time. So I'd like to just leave you with a few points key points to remember here. First thing, mutual funds offer diversification and the ability to invest at low costs, typically, professional management and the ability to easily choose investments that fit your goals. These features do not guarantee that you're going to earn a profit or be protected against loss. That's why it's important to understand the various risks associated with this type of investment. So if you want a diversified portfolio without selecting individual stocks and bonds on your own, mutual funds can be a good choice for you. So with that being said, though, because our investing philosophy here at Edward Jones focuses on the long term, it is important to note that a mutual fund can be held as a long-term investment. Do mutual funds fit into your investment strategy? Well, that depends on your specific situation. So be realistic about your risk tolerance, know your financial objectives and what level of risk you're comfortable with. And then make that decision on your own to figure out whether or not it's a good strategy or yourself with a financial advisor. But I know that was a lot of information to go over in 30 minutes, so I would like to open this back up. So if Danielle's still there with us, feel free to open this up to any questions that there might be.
Sounds great. I'll go ahead and stop the recording.